All right, ladies and gentlemen, I hope you had a wonderful day. It was already a crazy week with all of the data, but what happened with the meme stocks today just made it that much crazier. If you don't know what happened, Keith Gill, a.k.a. RoaringKitty, the GameStop movie, the guy who was responsible for the ultimate rally back in 2021, his last tweet was June 18th, 2021, and today, this morning, this was his first tweet, and it made everything go crazy. Now, there's a lot of things going on. There is a lot of theory going on about this. This wasn't his only tweet. After this one, he waited a little bit, and this was actually the day before, but as the market was opening up, he started tweeting once every 30 minutes and was posting all of these videos, and everybody has a lot of theories right now. So we got a potential short squeeze. We have a couple of other things that we have to deal with. We get PPI data tomorrow in the morning, and then CPI on Wednesday, and then in the middle of it, you might just get another short squeeze. So, Chad, we got a lot to talk about. I have the plays. I have a little bit of the theory that we'll go over. We'll talk about what happened in the market, and then I have all of the plays that I made today. I made a couple. I have one of the crazy stocks that I'm looking at, and then I have a lesson on gold. If you've been following along, I think you might enjoy it. So what I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Walking to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, before we get into the keys, let's talk about the theories, and you might be asking, why does this RoaringKitty guy cause this reaction? He was the OG behind the GameStop rally. That's the first big thing, but the fact of the matter is he has not made a public comment in almost 3 years. Why? Because ever since he had to deal with all of that stuff, believe it or not, they put a gag order on him from the last time he was dealing with all of these cases and going before Congress, and it just expired a week ago. So that's where people are saying maybe he's back in the game, and really the first theory is obviously GameStop, and people are looking at all the videos that he posted, and they're saying, well, these are his subliminal messages saying he's getting back into it. And if you don't know, if you even go back beyond, it's like this isn't new for RoaringKitty. It's not as if he is Sam Bankman and speaking in a weird cryptic language. He did this all the way back in the day during all of it, even when GameStop was going crazy and all of that good stuff. So this is totally within his character. Some people are saying it's to keep him out of trouble or all of that, but this is what he has already been doing. But now, here is the other theory, and it's kind of gaining some traction, and I'll just show you the final aspect of it, is that every single one of these videos, it was a movie. And if like we were going to decode this like the Drake-Kendrick beef, some people are saying this is leading into AMC. And then here's the best one. He just made his tweets today, but if you go to Homie's likes, the only tweet he liked in the last 4 years is Taste of Cinema. What is the best movie that you have seen? And then you go click on the tweet, bro. You'll see everybody. They'll be like, I saw one with like GMC apes and all of that. So yeah, we'll see how it all plays out. But Chadadonia, this is the theory for now, and this is what I was saying is like, dude, it could be cool. We'll see if this ends up playing maybe lightning strike twice, huh? But the whole point is be very careful. I mean, we saw how all of this ended up, but if this starts to get legs and it wakes up everything, especially if we start getting near rate cuts, the simple idea here is short squeeze stocks. If we watch around 2 and GME and all of that, then those would be the plays that would go up. But for now, and we'll talk about this when we get to the plays, no one really knows what's going on. This was all just a result of him tweeting in the morning. The stock went up 50%, and then after that, it was all a wrap, and then it's even going up a little more after hours. So, Chad, what do you think, baby? Post that in the comments. But now, getting into the first key, you should be aware we have the PPI and CPI. They will still be the main events, but now depending on how this GME thing plays out, if it does lead to a short squeeze, this could be another catalyst that we're going to have to play with. So what I mean by that is that this is either going to be a big event or it's not. We're either going to get distracted by the CPI, PPI, and all of the data, or if this squeeze does get out of hand like last time, there may be things that happen like we saw. And really what I'm waiting for is the point to which if we get a squeeze, it starts leading to value names getting sold off, or we've been talking about liquidity. If some names get squeezed a lot and we really start to sense a fund or someone's under pressure, you will start to see liquidations of quality names. So until we get to that point, this is still just the early days, but maybe that could give you a target to look out for. But PPI, CPI tomorrow morning, 1 hour before the bell, we are going to be getting that data, and that is still something we got to watch out for just in case this hype momentum fades really quick. But now the name of the game with all of this, it's going to be expectations coming into Wednesday. We had inflation expectation data today, and that wasn't good. It caused a reaction of the bonds, and the bonds even traded lower than when the data came out by the end of the day. The market moved a little bit, but tomorrow's PPI, I'm not worried about those expectations, but however that PPI comes in tomorrow, I think that is going to move the CPI expectations. And we talked about this yesterday. A lot of people asked about this on stream, and we had to bring it up a lot. It's really important. Even though you've been getting hot inflation data, just think the last 2 months. That is literally what everybody has been worried about. Despite that, the expectations for CPI on Wednesday are for inflation to come down by 0.1. Now today, those bad inflation expectations, they didn't move consensus too much, but now tomorrow, that PPI, if that comes in hotter, we may see CPI expectations go through the roof and vice versa. If tomorrow's PPI comes in lower, it is going to solidify this idea that CPI should go lower. But the weird part about this is, one, how we've had the data over the last few months, but it's like, why are we expecting something low? It just kind of makes it easier for us to get disappointed. But if PPI comes in hot tomorrow and expectations do shoot up ahead of CPI, then I will think it will be easier for us to beat the number. But the point is, expectations, I think, are really going to rule everything. And now these little data sets in between, that will kind of be what dictates whether or not we have a high or a low bar to beat for the CPI on Wednesday. So watch out for that. The final thing I'm going to leave you with here is liquidity is still low. Even though we had a lot of short covering and a little bit of the squeeze today, volume was about 7% lower than average. Last week was very low volume. We're even watching short squeezes once again, and we're talking low liquidity, and there was even a couple of commodities that moved today. It is definitely something that's catching my attention. So depending on what happens after the CPI, I will still be keeping an eye on this. If we keep seeing more indicators of low liquidity as we get into like June, July, and other movements, I'm going to take that as a really bad sign. So watch out for that. Otherwise, we'll just see where the data leads us and go from there. But now, let us get into the plays. So, right off the bat, I got a couple of different plays, and some of you may be disappointed by this, but MPW is my first one. And why you would be disappointed? Because this is my GME. We'll talk about it. I'm probably not going to play GME, but the thing I like about MPW, it just fits the criteria of being heavily shorted. I already liked it for value. When we bought it, we thought it was distressed. Things got a little worse after that, and then this became one of my worst long-term positions. But the fact of the matter is, if I'm going to get involved with any of this stuff, I don't see GME as like the play to go to. But hey, MPW, it's almost 40% shorted. There is a lot of things that could push it in a hype narrative, but then I like the real estate. If rates come down, that could help it out. If management gets their $2 billion of liquidity and pays off the debt, those are all reasons I like with or without a short squeeze. So if it gets above that $6 level that we talked about, and then with all the people who are shorting it now, maybe we get a little bit of craziness. But this is going to be my play in the midst of all of it, but we don't really know what's going on. I'm saying it meets the criteria of being heavily shorted, but we don't know what Keith Gill is doing. Roaring Kitty, we don't know if it's going to lead to one stock, many. So as of now, it is still very early. And then on top of it, we saw a ton of different names go crazy that kind of had this type of move, like NVAX. I think AMC even went crazy. Again, some people might be speculating that's what he's getting into. Just be careful. Adam Aaron loves the piggy bank, so watch out for that. But there was a ton of different movers today that really got involved with this. So until we finalize it and see really what's going on, it's hard to pick them out. But for now, I think MPW will be my horse if we do get into a short squeeze race. So watch out for that. That is play number one. Then play number two, Baba. It went insane today, so this would be week number 4 if the China stocks could rally. I would definitely keep your eye out for it, but now here's the deal. Baba has earnings tomorrow morning. I think Baidu is Wednesday or Thursday. We're going to get some of these Chinese earnings and see if it continues what they've already done. They've had a lot of good, surprising economic data, but now we'll see if this continues, and if Baba does do good, if they have a good report, I do think $90 to $100 is in play, and especially if we start getting that squeeze element, I think they could get a lift as well, too. But in general, there's a lot of China sympathies out there, from Tesla all the way to Baidu, JD, Pinduoduo, the ones directly related there. So watch out for that. I did make a play on that. We'll go over that in a little bit. And then finally, play number 3. You guys know the name on this one, but this surprised me. I think it hit almost a limit up today, but wheat. And it's just weird, man. I would keep your eyes out for this. This is another commodity to start going up. So I'd add that to the list of things, but very wild. It's been on a huge tear, and it's knocking right below the door of 7. So it's been a couple of years since we hit our first wheat play. Maybe this comes back here. If you remember that interview with Sal, the 3 to 5 year cycles, maybe that's what we're getting. Some people are saying war, but I just want to point this out because it's abnormal. It's moving up now, especially after being depressed. Mix that in with everything else, the commodities, some other agriculture names, even cocoa's been going wild. This really was a wild one. I don't have a play on it for now, but I'll definitely be watching that, especially if other things heat up in low liquidity and all of that good stuff. So those are the main plays. As far as everything else, I did make a couple of plays today. I did go for MPW. I have a lot of shares to flip at like $7. Our long-term, we got like 1,000 shares at around $8. So we're still down on all of them. Again, I've got murdered on this one. It has been no secret. We bought it distressed, and then it just got more distressed. I don't know. That's like double strat. I don't know. But point is, I liked how it was moving today. I didn't want to go too crazy, though, so I tried to get some of these options, and I grabbed the MPW January 26 $12 calls at 37 cents. I grabbed 7. I was trying to get more, but I couldn't get filled at that price, so spent about like $200. And why I went with January is because time is of the essence here. If there is going to be a short squeeze, if it's going to be a massive, crazy move based on hype and all of that, and there is a huge underlying move, it's just, if you know options, the ones with a large amount of time, those are usually the ones that are mispriced. And in this case, those weeklies, by the time, because I even said, I was like, let me end this rally and let me buy it while it's going up, because that usually, you know, when I top ticket, it'll come down. And I did it, and it didn't go down. It shot up like another $1.50, and that was kind of surprising. But even when the stock was already up, a lot of the options on the short term, they were up anywhere from 100 to 150% or like 400%. And these ones a couple years out or 2 years out, even though it's super far out the money, 100% up, you got to think about that. That's the downside to this play. This play was only up like 30 or 40% or something like that. It did not have as much premium. So got a little bit more. Otherwise, I'm going to ride my shares. I'm not going too crazy. We'll talk about another idea that I could have there, but that was the first play that I made today. And then the second one, I went with a Baba weekly. And now this one's interesting. I grabbed 5 of the 102 calls that expire this week. I spent $55, 11 cents a pop, and I'm going for the overshoot. Like I'm telling you, if their earnings is good tomorrow, I think it could go to those $90 and $100 levels. I believe 2 standard deviations was around like 93 to 95. The fact they're getting involved with the squeeze, China rally, if they could come with good earnings, Bank of America said it, one of the biggest pain trades right now in the stock market would be China stocks outperforming. Think about the beginning of the year. This time around, people didn't really chase it like Wall Street did, and it spent a couple months getting lagged. If you're telling me soft landing, no landing, everyone goes for AI, and then the chips pull back in second half, China goes nuts, a lot of people would not be prepared for that. So it's getting interesting, even though the data has been back and forth. But I'm saying, hey, if that earnings is good, we're getting this squeezy environment. I went for the weeklies and a further strike price so I could get more quantity. And if it does have that overshoot, hopefully get a better return. But we'll see what happens. And at the end of the day, trying to keep it small because like I told you, man, last earnings, we did very, very well. You guys saw it, 1,000%. Pop just off the hip, bro. It was dope. But every single earnings play got wrecked. There was a couple that I won on, but I'm telling you, even dollar amount and how it's just dirty, bro. So you got to be careful. And remember, the way you protect yourself is by keeping the balances low. So don't ever forget that. But that is all of the plays. If you have any other questions, want me to cover anything else, you let me know. But the final thing we got to do now is questions of the day. I got a couple of good ones for you. And number one, are you playing GME, Josh? No, I'm not. If I'm not going to play it. I probably won't. If there really is real hype around this, I'm going to pray and hope that it leads into MPW. And like I said, I already have good exposure. I've kind of explained, I like it for other reasons. I have doubted MPW, but if this brings it out, it will be good. And this is something I said on stream today. I'm going to hold for my 10 years. I made my plan, bro. I sit with it. I ain't going back on that. You know what I'm saying? But at the end of the day, MPW was one of my worst long-term plays. And if you hated it and you're like, I hate you, Josh, this play sucked, and you really doubted it, because again, management changed a lot. We bought it when it was distressed. They cut the dividend. They did a lot of other things. It's a miracle. It's even still like holding up, and thankfully they've gotten a lot of liquidity now. But the point of the matter is, if like you really doubted this play and you didn't like it and this movement, because some of you, if you bought the dips, Chads have already sent me, they're up like 30, 40 on this, which is nuts. But the fact of the matter is, if you really wanted to get out of this and it gave you a lot of pain, and this little rally gives you an opportunity to exit, I would take it. I'm probably not. My average is still around $8, so we'll see how it plays out. But even then, I mean, I would want to give this a little time, but I would not give you any shade. If this play gave you a lot of problems and you're getting a get-out-of-jail-free card, you could take it if you would like, man. So keep that in mind. And the only other theory, somebody was asking me, like, am I going to play any of these plays? And I just said, probably not. I'm going to go for the MPW. If things do go crazy, the only other crazy idea I would have would be, if I'm going to use my trading money and I wanted to get in this hype, I would close all my other plays. That's part of even the liquidity stuff going on right now. And then I would just throw it all into one, probably MPW. So we'll see, but that's dangerous, and I don't know. I haven't made up my mind on that for now. I'd like my exposure, even though it's coming up. I'm still down on it. I have enough, and I could be content with that. And long-term, still kill it. You know what I'm saying? So keep that in mind, but hopefully that helps you out. Number two now, this was a great question, and I think it relates to everything going on. They said, what is the difference between short interest and short ratio? So I thought I would answer this and just kind of like just sprinkle a bunch of fun facts about shorting and all these numbers. But technically, it is called the short interest ratio. And the short interest ratio is the number of shares shorted divided by the average daily trading volume. That is giving you a ratio, a percentage of how much of that stock is shorted relative to its daily volume. If you just look at overall short percentage or the shorts outstanding, that's just going to tell you how much is shorted relative to the float in what is available for trading. The other concept of shorting is DTC, and that is days to cover, and that's literally how many days it would take for all the open shorts to close at the average daily trading volume. Again, it's like ADV, average daily volume. That is a big concept when it comes down to shorting. And then the thing that a lot of people have to keep in mind when you go look up short interest and the percentage of how it shorts. Usually that data is like 7 to 14 days delayed. Sadly, there's like how it's supposed to be reporting. You don't really get real-time updates on this, and this is where I could give you some good info. There is a company, they have a Twitter, you could go find them, but they have a service, S3 Partners. I'm telling you, they are the best in the game when it comes to this data. They have it all live. They show you all of it. They have their own ratios and metrics. I've used it before. They gave me a trial, and it was mind-blowing what this platform provides, or just this data service in real time. Unfortunately, it's about like $1,500 to $1,800 a month, and it's usually through the terminal. I think you can get it without a terminal, so it's not like you have that. And Bloomberg banned me because I share all this info. But if you do want info, I would keep an eye out for S3, and if they say anything about this situation, those are the guys to watch. But hopefully this all helps. Some of you are in love with this topic, so feel free to sprinkle the comments with some knowledge, baby. But hopefully that helps. And now finally, it's not a question, but I have a question for you, Chad. Can I show you something with gold? I want to go over a little mini gold lesson. Comment if you want more of the gold history, because I think, I was looking through the book and trying to think of some economic lessons I could give you, and I was like, gold, we're talking about it in liquidity, and just like, man, from understanding autonomous governments to fixed exchanges and there's a lot of history, and I think it could be good. So are you cool if I show you this lesson? Comment below if you want one, but I already have one ready. So unfortunately, I asked your permission, but like I'm saying, for the second one. If not, I won't do a lesson number 2 on gold if you don't like this. I've done some other ones in the past, but today what we are going to be going over is some of the history of the classic gold standard. Now, if you have gone through some of the other lessons, you should understand how we got to the monetary system we have today. It is no longer backed by gold. So if you're not aware, your dollar is not backed by gold, but there's a huge history. And oftentimes we talk about Bretton Woods and that change, but dude, it's deeper than that. And I hope I could expose you to some of that. And then if you want to follow up, you let me know, but let's get into it. The classical gold standard. Governments based their exchange rates on the gold standard prior to World War I. In this system, governments exchanged national currency notes for gold at a permanently fixed rate of exchange. Between 1834 and 1933, for example, the U.S. government exchanged dollar notes for gold at the rate of $20.67 per ounce. Because all national currencies were fixed to gold, all national currencies were permanently fixed each other as well. I didn't want to stop too much, but I think this is a big point, because I think we oftentimes overlook it. And, people say, well, we should go back to a gold standard. Well, think about it. If you do go back to a gold standard, if everybody adopts that, if that's really what you're on, I mean, you need kind of everybody to go against that, because it's universal. So the gold standard emerged at the center of the international monetary system during the 1870s. Great Britain adopted the gold standard in the early 18th century, but most other currencies remain based on silver, or a combination of silver and gold, a bimetallic standard. During the 1870s, most European countries, as well as the United States, abandoned silver as monetary standard. Much of the rest of the world followed. During 1880s and 1890s, the rapid shift to gold reflected what economists called network externalities. The benefit of adopting gold grew in line with the number of countries that had already adopted gold. This exchange rate stability facilitated the rapid growth of international trade and financial flows in the late 19th century. With exchange rates permanently fixed, prices in each country moved in response to cross-border flows. Prices rose as gold flowed into the country and fell when gold flowed out. So I want you to see, maybe we could follow up, but really pay attention, and maybe you can listen back on this. But what you have to understand is everything with monetary policy, or even just like exchange rates, when trade and the value of money moves, it influences money going in and out of a country, whether that's capital or through goods and trade. So that's what this is explaining. Cross-border gold flows were in turn driven by the relatively autonomous operation of the price-specie flow mechanism. The price-specie flow mechanism worked in the following way. Suppose the United States experienced a sudden acceleration of economic growth with the U.S. money supply, its stock of gold, fixed in the short run. The growth spurt would place downward pressure on on American prices. With more goods to buy with a fixed amount of money, the average price of goods must fall. As American prices fell, American exports would rise and American imports would fall, thereby generating a balance of payment surplus. This payment surplus would pull gold into the United States from the rest of the world. The resulting monetary expansion would push American prices back up to their initial level. The rest of the world would simultaneously experience countervailing dynamics. It would develop a payments deficit as the necessary counterpart to the American surplus. This deficit would generate a gold outflow, the necessary counterpart to the American gold inflow, and this gold outflow would push prices down in the rest of the world. The price specie flow mechanism is like price specie or specie. I remember in college, I always say words wrong, so I don't know. Thus imposed recurrent bouts of inflation and deflation on the societies linked by gold. So my gold bugs, I don't see Peter Schiff talking about this, but again, a lot of people say we should go back to the gold standard. Hopefully this is showing you, I mean, there's consequences and there's big in what it does to trade, but long story short, inflation and deflation and recurrent bouts in this like vicious cycle on gold standards, this was a big feature of that. And then again, this is back to like the 19th century, but governments were not supposed to use their monetary policy to counter these price movements. Instead, governments were supposed to follow the rules of the game. These rules required countries losing gold as a result of external deficit to raise the discount rate, the interest rate at which central banks loan to other banks, to restrict domestic credit and slow domestic investment. Tighter credit would reinforce the deflationary pressure caused by the gold outflows. Countries accumulating gold as a consequence of an external surplus were expected to lower the discount rate in order to expand credit and boost investment. Lower interest rates would reinforce the inflationary pressures caused by gold inflows. In essence, therefore, the rules of the game required central banks to set monetary policy in response to the developments in their balance of payments rather than in response to conditions in the domestic economy. In this way, the gold standard forced governments to subordinate internal price stability to external exchange rate stability. So this is huge. Because like it's saying, if there was certain things that happen with price movements or trade and it would cause these bouts of inflation and deflation, it would cause these countries to have to respond if they were a recipient of having less gold or more gold. And then again, we're talking central bank autonomous, right? Autonomy. Well, think about it. You have no autonomy when now you have to respond to the inflation and deflation every single time due to the gold standard. Now, again, this is all back in the day. So the resulting instability of domestic prices was substantial. In the United States, for example, domestic prices fell 28% between 1869 and 1879 and rose by 11% in the following 5 years, and then fell by additional 25% in 1884 and 1896, and then gradually rose through the next 15 years. The coefficient of variation provides a more systemic measure of domestic price instability. The coefficient is the ratio of the standard deviation of annual percentage change in domestic prices to the average annual percentage change. Greater price instability generates a larger coefficient of variation. Between 1880 and 1930, the coefficient of variation for the U.S. was 17. In comparison, the coefficient for the post-World War II era, a period of greater exchange rate flexibility, was 0.8. Thus, even though the gold standard stabilized exchange rate, this external stability came at the price of substantial domestic price instability. Domestic price instability provoked political conflict. One such episode occurred in the United States in the late 19th century. Western grain farmers were hit particularly hard by deflation in 1884 and 1896. Commodity prices fell more rapidly than did the price of manufactured goods and services that farmers purchased, thereby reducing farm purchasing power. In addition, most farmers were in debt, and falling commodity prices required them to dedicate more of their income to debt service. The West responded by advocating the return to a bimetallic monetary system. They argued that monetizing silver would expand the money supply and raise commodity prices. The movement peaked in 1896 when the pro-silver wing of the Democratic Party defeated the pro-gold wing at the party's national convention. The victory was symbolized by the nomination of William Jennings Bryan, who had delivered a passionate speech at the convention in which he avowed that farmers would not be nailed to a cross of gold. As the party's candidate of 1896 presidential election, Bryan lost the presidential election to the Republican William McKinley, and the Silverites subsequently lost strength as commodity prices rose and remained high until the end of World War I. So that's your history lesson for the day. I hope it helped. I hope you guys like it. But like I'm saying, I usually talk about like post-World War II gold. I thought it'd be cool to give you a little pre-World War I. Should we talk about all the other eras? You let me know. But Chad, that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, man, there's a lot of things in life you could fret over. But if you fret about evil succeeding, I would argue that's worse for you than wishing bad on people. Yes, don't let it get you down a slippery slope, baby. Focus on the good things. Have a bigger faith and stay in the game, Chadadonia. So that's all I have. Drink the water, hydrated, healthy, all that good stuff. I'll see you in the AM and horn.